recording. And so we're talking about revenue recognition. Okay, so basically we need to define what revenues are. Revenues are inflows of assets or settlements of liabilities, and they originate from delivering goods or services that are related to the main business activity, all right? Not from peripheral activities. And there's two important things or aspects of revenue recognition that we need to pay attention to. How much, so measuring the amount that we're going to recognize, and when, so the timing of the recognition. So what you've learned from BA 200 and what we were discussing regarding the revenue recognition so far this semester, we said, revenues recognized when it's earned, right? That means that when the activity is completed or the transaction is completed, I have delivered the goods, I have performed the service, so now I'm going to recognize the revenue. Now, due to, I guess, technological advancements and advancements in commerce, there are actually many varieties of products and services that are provided, sometimes as a lump sum. Okay, they're like a package deal. And so when we have multiple deliverables, which is called, then we're going to have to try to allocate and analyze how is each part of that component going to be recognized. So under ASU, so this is the FASB codification number 2014-09, we have come out with different steps in recognizing revenue, and we're gonna go over those steps in a little while. Okay, so we already talked about when we will recognize the revenue when it's transferred to the customer, okay, and how much is exactly what we are entitled to receive for providing the service or delivering the goods, okay? So we have 5 steps to revenue recognition. The first one is to identify a contract. So we're talking about more complex transactions. So we're not just talking about, okay, I'm going to Payless and I'm purchasing an item. Of course, Payless is going to recognize that at the register when I make payment, right? Or I go to Kmart, Kmart's going to recognize it when I go to the register. That's point of sale. So we're not really talking about that. Well, we have a little bit discussion about that, but for the most part, we're talking about more complex transactions. And so for the most part, we may have a contract. So we have to identify the contract. And as an accountant, you're going to find out that you're going to be reading a lot through, contracts, to make sure to understand what exactly is going on and lots of documents and things like that. And so that's where your business law courses kick in. All right. So we have legal rights of the seller and the customer. Those are explained in the contract. We have to identify the performance obligations, and we're going to go over some examples to see that sometimes this part, number 2, is a bit more complex. Okay, the termination of a transaction price, that can be a little bit more complicated when we're dealing with multiple deliverables, and then we have to allocate a price to each. And then once that we have designated the price and we have identified the different components, then we have to see how are we going to recognize the revenue for each one of those components. All right, so recognizing revenue at a single point in time is probably the most straightforward and easier to understand in terms of revenue recognition. In terms of when do we recognize the revenue, the customer has control of that asset. Okay, it has an obligation to pay the seller, has legal title, has transferred to the customer. The customer has physical possession of the items. It could be inventory, for example, and that way they assume the risk of ownership and they have, of course, accepted the asset. Okay, so we have an example here. True Tech Industries sells a Tri-Box, a gaming console that allows users to play video games individually or as multiplayers. Is a module and includes no other goods or services. When should True Tech recognize revenue? So we have on December 20th, 2020, Com Stores orders 1,000 Tri-Boxes at a price of $240 each, promising to make a payment 30 days after delivery. So nothing has taken place yet. The Tri-Boxes have not been delivered, so that means that there's no transaction really. It's just a placement of an order of this product and nothing else is going on. So there is no entry. We're only making a journal entry when the goods are actually delivered. And in that case, we're going to recognize the revenue. Okay, there will be, of course, another second entry here, if you recall, to recognize cost of goods sold and then credit inventory, which is coming up in chapter 8, I believe. Right? And then when the payment is received, we debit cash and we credit the receivable. So this entry you're very familiar with. Yeah, I know sometimes, when we are looking at very complicated things, we forget the basics. So back to the basics here. We're going to recognize the revenue when the goods are delivered. We debit accounts receivable in this case because it was on credit. And then when we receive the payment, we debit cash and we credit receivable. All right, pretty straightforward. You guys are familiar with that. All right, now we come to where we're going to recognize the revenue over a period of time. And we do this, we recognize it over a period of time if it has met these 3 criteria that we have here. The customer consumes the benefit, the customer controls the asset as it is created, and there's no alternative use for this asset. All right, so we're going to have to recognize a portion of the revenue gradually. And that's, you're used to this already. We should be familiar with deferred revenue. I think in BA 200, we called it unearned revenue. It's the same thing, unearned or deferred. The textbook calls it deferred. So we'll go with the deferred revenue, but it's, the BA 200 was unearned revenue. So True Tech Industries sells 1-year subscriptions to the TriNet multi-user platform of internet-based games. True Tech sells 1,000 subscriptions for $60 each on January 1st, 2021. So they received the cash, but as the subscriptions expire, that's when we're going to recognize the revenue. So at the onset on January 1st, nothing has expired, so we have a deferred revenue. And if you recall, deferred revenue or unearned revenue is actually a liability. Okay, so we have a liability here. That means we have an obligation to provide the benefit of the subscriptions to our subscribers. And once that we do that, okay, so here it was for 1 year, so we're taking the 60,000 divided by 12, and we are going to be recognizing $5,000 at the end of every month. Okay. And again, I hope that, or maybe this is just a refresher of our BA 200 journal entries. Recognize the revenue when the three criteria do not apply. So if a poor performance, remember that we had the three criteria that we listed before in the previous slide. And if we don't do it over time, then we're just going to do it when it's completed. Okay. In terms of assessing when completion has taken place, especially if we are gradually recognizing the revenue, there's two forms to do this, or two ways to do this. One is output based. So we're looking at, and you'll see this when we talk about percentage of completion, the output and input based. So output based relates to the proportion that we have already completed. So we're based on what have we produced so far. Input based is, well, how much cost have we, incurred at this point? So that's looking at the input part. All right, so we have recognizing revenue for contracts that have multiple performance obligations. All right, and some of these you're very familiar with. It's just that you didn't think about how does the seller, recognizes the revenue. So, for example, I'm pretty sure everyone has a phone, right? A cell phone or a smartphone. And so you can think if you have entered in a contract with Docomo or IT&E or whichever one of those companies, and you signed that 1 year or 2 year contract, and then they gave you a phone right at point of sale. So how is that company going to recognize that, right? So we have a multiple performance obligation. We have a phone, right, from the company's point of view that they've given to the customer. And of course, they say free or no cost, but the cost is embedded in the service, the price or the cost that they are charging you, right? Nothing is free, unfortunately. And so, and then there's going to be a gradual recognition of the income for the 2 year contract. So you can see how we could have these multiple performance obligations are actually more common than we think. And so going down the 5 steps for revenue recognition, we're concentrating in terms of this in step 2, identify the several performance obligations. And then we're going to have to, once that we determine the transaction price, then we're going to have to allocate that price to the different components and then analyze how each component is going to recognize the revenue. All right. So identify the performance obligations. In order to distinguish performance obligations, we need to make sure that they're distinct and that we are able to identify them separately, meaning that I can assign a price or a portion of the price to the item number 1, and I can assign the portion to item number 2. Okay, I can distinguish that and I can do it. So here we have an example back to, I don't know if we have any gamers in this class. We have TrueTech Industry manufactures the tri-box system with the multiplayer gaming system. And what we have here is we have the console, right, the module, and then we have the 1 year subscription. And we're selling that to our customer for $250. Now we do have a value for each of these components, right? For the 1 year subscription is $60 per month or annual, right? Per year. Yeah, it says 1 year. Hello. And then for the module is $240. So we have a fair market value for each one of the components. And the seller has provided a deal, a package deal for customers of $250. And so we deliver 1,000 of these. That means that we have received 250,000. All right. And so we go through the 5-step determination. We have a contract because we have delivered the goods, right? So the customer has taken possession of that. So now we have a contract, and we're able to distinguish two performance obligations. One being the module, which is given to the customer at point of sale, and the other one is the subscription, which is the $60 per year, which we're going to have to recognize gradually, right? So we have two performance obligations. Okay, so we already determined that, and we have a price, $250 per item for this package deal. We sold 1,000 of them, so we have revenue recognition of 250,000. But we're gonna have to split the 250,000, right? Because we said one is gradual and the other one is at point of sale. So since we know what the standalone price is, their fair market value, then we can do an allocation to the 250. So we take 240 for the modules divided by 300. And so 80% of the selling price we're going to allocate to the module. And then the $60 divided by 300 is 20%. The other 20% we allocated to subscriptions. So that means that for every item that I sell, $200, I'm going to recognize the revenue at point of sale when I give it to the customer. And then the $50 we are going to have to defer until it's actually the subscriptions expired, right? So remember that we sold 1,000 units on account. So we have accounts receivable of 250,000. We have the 250,000 multiplied by 80%. This is the modules, right? And so we're recognizing that at point of sale because the items were delivered. And then the subscription is going to be our deferred revenue part, which we're going to have to recognize gradually every month or at the end of every month. Okay. So if we take 50,000, that was the allocation for the subscription divided by 12, we're recognizing revenue at a rate of 4,167 per month. All right, and this is just expanded explanation of the 5 steps. Okay. And now we come up with, certain issues that may come up with revenue recognition that we need to mention. Okay, so we have exactly what do we mean by contract. And this contract can be oral or written. And we have the criteria for a contract to exist. It has to have commercial substance. It's an agreement by the seller and customer, specifies the rights. I think we went over this. It has payment terms. And of course, there's a high probability, or the seller at least expects that the customer is going to pay them, right? A contract does not exist, all right? Neither one of the two parties have performed any obligations. And both the seller and the customer can terminate the contract without penalty. Yes, a contract only exists if so all of these items have to be part in order to be a contract, okay? So here we have to see whether a contract exists or not. We have Comp Stores order 1,000 TriBox systems on December 2020 at a price of $250 per unit. Assume that Comp Stores and TrueTech can cancel the order without penalty prior to delivery. TrueTech made delivery on January 1st, 2021. And I know you can see the answer, but think back. Remember, we had this example where we just order. We call the merchant and we order the inventory, but there's no transaction. There's no really exchange of anything. The seller hasn't delivered the goods. So in that case, there's nothing going on. And then here we're told that they can cancel at any time without penalty. And so that means that a contract does not exist. Okay. And it doesn't exist until the goods were delivered on January 1st, 2021, because one of the parties performed their obligation. Okay. Don't worry too much about this. Don't worry too much about this. Okay. We're talking about a discount, okay, a coupon. And this is very common. Sometimes I notice when I go to Kmart, they'll print out their register, the receipt, and then on the receipt may have something like, on your next purchase, you can use, 20% off on shoes or something like that. So that's a coupon that they've given me after I made the sale, right? So it's very common to give these coupons out to encourage customers to come back to that merchant, right? So this is something that we see very often. So now we get an opportunity to see how the seller, the merchant uses that, and how do they record it for accounting purposes, right? So we have TrueTech offers a promotional coupon with every TriBox it sells for $240. The coupon gives TriBox customers an opportunity to buy headset that normally sells for $150, and now with the discount they can purchase it for $90. Okay, so there's a $60 discount. We have here the calculation. Basically, the 150 less than 90 is $60, or you can take 150 multiplied by 40%, and that is your discount, right? And they have to redeem it within 1 year. TrueTech estimates, so the seller or merchant always has to estimate the percentage of customers that will actually redeem the coupon. All right, so you need to pay attention to that. And they may use, prior experience to base that percentage to come up with a percentage. And so we need to come up with a price for, or a value for this coupon. So we know that the discount is $60 and there's an 80% chance that customers will redeem it. So we come out with a $48 value that we can factor into into our journal entry. So in terms of the coupons are deferred, right? Because we cannot recognize the revenue for the coupons right now. The customer just walked away with it until they actually redeem it, okay? Until they actually redeem it. And so we note here that the sales price in this case, I just want to highlight it because it's different from the last example. It's $240. And can you guys see my screen?
Yes.
Okay, I think my connection, my Wi-Fi is fluctuating a bit. Maybe it's all this rain. It's all this rain that we're getting. All right. And so we have our standalone price for this, is it a module? Forgot what it was. I think it was a module, $240. And then we're adding the value of the coupon. So we have $288. We only got paid, of course, for this module that we sold. And so we're recognizing that revenue here. We're actually doing an allocation again, because our total that we are going to, a portion is going to be recognized now and a portion is going to be deferred. So we're taking the 240 and divided by 288. We take that percentage and multiply it by the 240, and we come up with $20,000. And then we take that 48 again, divided by the 288. So again, we're just doing an allocation of the 288 based on the values that we assigned to the module and the coupon. So it's very similar to the one that we did previously, except that now we are actually we're adding this coupon to our selling price. And so anything that's related to the module at point of sale, we're recognizing, and we're left with $4,000 of coupons that is deferred revenue, and we're going to recognize that when the customer uses the coupon. After, remember, I think they said that there was an expiration date. I think they mentioned an expiration date. Oh, here, redeem within 1 year. So after 1 year, if we still have a balance in deferred revenue, then we're just going to write it off. Okay, we're going to take it out. Okay, now we come to, we need to make a determination of the transaction price. We have different ways to do so, and we're going to go and cover some of these, not all of them, because it might be a bit overwhelming. Just as long as you guys have an idea exactly where we're going with this, I think that should be sufficient. So I'll let you know things that we can leave out. So in terms of variable consideration, this is a common practice again. Once we get to the exam, I'll let you know exactly what we need to concentrate on. I will say just take a look at what I included in the assignments, the topics that were included there, and that should probably be the focus of our next exam. Yeah. So again, variable consideration is a common practice. You may have that perhaps in construction, or if you finish it up within, I don't know, 5 months, then we're going to give you an incentive payment to do so, okay, an extra payment. It could be in healthcare, you have Medicare, Medicaid reimbursements. You may have rebates. Okay, so all that is very common practice. And so how are we going to estimate whether someone is going to finish within that time that we said they were going to finish, or the rebates that we're going to get and all that? So we have two methods to calculate these variable considerations. One is the expected value method. The other one is the most likely amount. Okay, so we have an example here. TrueTech enters into a contract with Pro Sport Gaming to add Pro Sports online games to TriNet Network. Pro Sports offers popular games like Brawl of Bands and wants to those games offer in the TriNet Network. So the terms of the contract are: on January 1st, 2021, Pro Sports pays TrueTech an upfront fixed fee of $300,000. Okay, for 6 months of feature access. Okay, so we can see that this would be a deferred revenue, right? Pro Sports also will pay TrueTech a bonus of $180,000 if the user spent at least 15 hours during the 6-month period. Okay, so there's a consideration here that we don't know if it's going to be met or not. So there's going to be some uncertainty built into this. And I know we're accountants. We don't like uncertainty. We unfortunately in the real world, there is a lot of uncertainty. Okay, so we kind of have to start tolerating that. And so here, of course, in these problems, we're given the percentages, but in real life, you kind of have to figure it out. So TrueTech estimates a 75% chance that it will achieve the usage rate that we have here of 15,000 hours. Okay, so we're going to be looking at the two. We said there's two ways to estimate that. The first one is going to be the expected value. So with expected value, so we said we're going to recognize the 300,000 as deferred revenue. Under expected value, we're saying, okay, so there's a 75%. Remember, it was 180,000, the bonus. So there's a 75% chance that we are going to actually, get the 480, which comes out 360. And there's a possibility, it's a 25% chance that we're not going to meet the stipulations. And so we come up with a total of 435,000. That's under expected value. Another way to do this is to take the 180, multiply it by 75% and add it to 300,000. And you come up with the 435. The second option is the most likely amount. Okay, so there's, as long as it's 50% or greater, then we are going to go ahead and recognize it. We're going to say, okay, the likelihood that this is going to take place is high, and therefore we're going to recognize it. So here, for the bonus, so for the deferred revenue is the 300,000 divided by 6. Okay, that's the deferred revenue that's associated with this what's the subscription, right? The 300. This is for allowing pro sports to have those features in the game. So that's the one that we're recognizing gradually. Okay, so we debit deferred revenue, and then we credit service revenue. And then we're also, because we're doing the most likely amount, and there was a 75% chance that we're going to actually recognize the 180, we're also recognizing the bonus as a bonus receivable. Okay, so what happens if we don't get the bonus? What happens if we didn't meet the 15,000 hours? And if that's the case, then we are going to have to reverse it. So if at the end of the 6 months, we didn't actually meet the 15,000 hours, we're going to have to debit service revenue and credit the bonus receivable. Okay. Okay. All right. Continuing on. Okay. You don't need to worry about the constraint. You don't need to worry about constraint. The right to return. Okay, so a right to return exists when a customer can return a good or because they're not satisfied with it. Okay, so this could be you actually, right? You purchase something on Amazon, it looks so good in the picture, and then when you look at it, you're like, oh, this is not even what I wanted. It's not the right quality for whatever reason, and you want to return it. Okay. So I guess if you didn't open it, you didn't use it, then you can return it. So exactly how do sellers deal with this? They're actually going to have to estimate the percentage of returns based on the amount that they sold of that product. So it's kind of like the bad debt expense, if you recall, where we had to kind of estimate the amounts that will be uncollected from making sales on credit. So the same way, every time that we sell an item, we have to estimate how much it will be returned. Okay, and again, they will use prior experience to come up with that estimate. So when you're looking at the income statement of especially merchandising company, you'll see that they have sales returns and allowances. So that's part of that. In terms of other situations that we may have, and this special interest for accountants, because if especially if you're an auditor, you actually have to make a determination of what exactly is going on, what is the function of that company in terms of others. Okay, they could be a network. Actually, the returns, Gerald, you probably just adjusted at the end of the year, the balance, up or down, depending on the amount of sales that you had for that year. Yeah. Okay, so in the principal agent relationship, you may have, for example, you have a company in Japan, okay? And that company in Japan wants to sell products on Guam. And so you may have an agent on Guam who is selling those products on behalf of the principal, meaning on behalf of the person in Japan. So what that means is this agent didn't actually purchase the inventory from this person in Japan. This agent is just working for the principal. So basically, if the agent comes to you and you say, hey, I want, I don't know, 10 boxes of item X, then the agent is going to go back to the principal and say, so and so wants 10 boxes of item X. Okay, the agent doesn't have the inventory. The agent is simply a conduit, okay, a middle person. So in that case, the person who's going to be reporting the goods is going to be the principal. They're going to have the goods in their balance sheet and income statement. The agent, all is doing is collecting commission. Okay, they're just getting paid a commission. That's all for doing what they're doing. So if we're looking at their income statement, the principal company is going to have any accounts that are related to the merchandise. So they're going to have inventory on the balance sheet, cost of goods sold on the income statement, while the agent only has, I know it's a bit shifted here, but actually there's nothing for cost of goods sold. Only has revenues from commissions. That's it. Okay, so it's important to understand that. In terms of time value of money, you don't need to worry too much about this. We didn't actually go over chapter 5 yet, but we will. So we'll put a pin on this. You don't need to worry about it. Okay, this is just in terms of estimating. How are we actually going to go about estimating a price, okay, for the customer? And there's different ways that we can do that. Remember when we talked about the module and the subscription? So we had a standalone price for the two components. There may be ways to calculate that. That was given, but if it's not, then there's ways to calculate that. One is, of course, looking at items that are similar to the items that you're selling, and then looking at what the market price of those items are. Okay, so that's the adjusted market assessment approach. We may have a cost plus margin, profit margin, if we don't have a market for that product. So we can use the cost of producing the product plus add the profit margin that we want to make on that. And there's also the residual approach. So if I know what, let's say I have two items and I know one of the items is down no price and I have a package deal, then I'm just going to plug that difference to the item that I don't know. So we have an example of the residual approach here. Remember back to the 250 package deal that we were setting the module and the subscription. We know the module is 240. We just don't know the value of the subscription. So that difference, the $10, we're just going to plug it to the subscription. Okay, so in this case, our deferred revenue is going to be the plug figure, the 10,000, and then our revenue is the 240. So that's the residual approach. And you can imagine that it can get a bit complicated as you have all these multiple deliverables. Okay, I'm just gonna mention these, as passing by. I did include a franchise, I think, assignment, simply because on Guam we have many franchises. So it'll be good just to have a look at the franchise. Just, FYI, basically. We have licenses, and you guys, if you download music or files that you download and you have purchased those, then those are the type of licenses that we're talking about here. It's just a point in time. It has standalone functionality. You have the right to use it. Okay. Let's see, going back to this, like a music download. Okay, there we go. Or it could be a movie. Maybe you downloaded a movie, and I'm talking about, you purchased it and you downloaded. So that revenue is recognized at point of sale, right? So once that you paid for it and you downloaded, then they're going to recognize the revenue. There's other types of licenses, and so we may have to recognize the license over the license period. So this could be like trademarks and franchise rights and brand names and logos. Those are revenues that are recognized over the license period. So if you have a license for, McDonald's, for example, and you're using their brand name and their trademark, then in the agreement, it says how long the license is going to last, and that's how you recognize the revenue, right? Okay. Franchises. Okay, so for franchises, you have a multiplicity of products. You have the license that is associated with the franchise itself. You may have licenses for trademarks and logos and brand names, any products that you are selling. So getting into a franchise is actually very capital incentive. Okay, it has its advantages. It has also lots of disadvantages. So that's something that you want to evaluate if you're considering a franchise. Okay. All right. Build and hold is basically when the customer, or actually we're talking about merchandisers, right? Let's say we have a retail company that goes to the wholesaler and said, I'm gonna buy 10 boxes of these white t-shirts, but don't deliver it to me yet. Just hold it and I'll let you know when you can do that. So in that case, we are not going to recognize the revenue until it's actually delivered to the customer. So the seller is going to hold that in their inventory, in their balance sheet, until it's actually delivered. And then consignments. Consignments are very common as well. This is when you it's kind of like the principal and agent. The person, the consignor, is the one that actually carries the inventory, and they actually hire a consignee. That maybe this consignor doesn't have a location where to sell their items, and so maybe the consignee has a location, and so the consignor is asking, hey, can you sell my items for me? Okay, so the consignee has not actually purchased the goods from the consignor, so the inventory does not transfer to the consignee. The consignee, again, is the middle person. They're just selling it for the consignor. And so the consignee is going to get a commission or a percentage of each sale or something like that. They're not going to carry the inventory on their balance sheet. The consignor does. Okay, so these types of relationships you need to understand, especially if you are, auditing. Yeah, that's the thing about consignment. They may have a way to do it already, and so they're not actually doing it the way that it's supposed to be done. So yeah, I guess if your financial statements or the company that you work for it is not being audited, or if it is being audited and the auditors, they're okay with that treatment, then I guess it's okay. But technically, according to FASB, this is the way that it's supposed to be handled. Yeah. Okay, we come to gift cards. Gift cards are common, very, very common. And of course, gift cards are going to be deferred revenue, right? Because we don't recognize the revenue until the person redeems the gift card. So that was just FYI. And of course, it's going to be lots of disclosures on the income statement, the balance sheet, and of course, the notes to the financial statements. All right. And the rest, just expanded explanations that adds kind of like a summary of everything that we've seen so far. That's what they had on those. And this one we'll defer to for next week. Okay, so this is the second part, which is the long-term contract. So right now we're just looking at the multiple deliverables and when do we recognize revenue.